Hello and welcome to Niaga Spotlight with me, Tamina Kauchi. Niaga Spotlight goes through the week in business and future affairs. Market watch, industries, analysis and insights, we've got you covered right here on Niaga Spotlight. Well, for this week's analysis segment, we take a look at China's economic slowdown and APAC impacts. Now, China's weaker than expected post-COVID recovery may hinder the anticipated narrowing of global current account balances during Q3 2023 and beyond. This slowdown in the world's second largest economy will also pressure vulnerable emerging markets and trading partners directly, the largest of which are located in the Asia-Pacific region, including Malaysia. Now, in fact, in 2022, bilateral trade between China and Malaysia reached a record high of $203.6 billion USD. So what are the causes behind China's economic slowdown and market-based structural reforms which can help lessen the impact on economies like ours? Dr. Sai Zi Xiao, Assistant Professor, School of Economics, University of Nottingham, Malaysia, joins us now online to discuss this further. Hi, Dr. Sai Zi, good morning. Let's get into the discussion. Now, I'd first like to ask you, property, other industries that contribute to it account for up to 30% of China's GDP. What factors, in your opinion, have created China's property market crisis and some negative sentiment in the housing sector, which has also been slowing down growth?
Okay, Tamina, thanks for having me today. I think one of the root causes comes from the debt crisis. And at the end of the 2022, as per the explained from the Bloomberg, over debt of the largest Chinese developer has reached 1.4 trillion yuan, while the developer has only touted cash totaling at about 147 billion yuan. So you can see the huge gap between these two figures. And also the company was not able to pay two bond payments already in 2022. And this funding crisis has even also affected the buyers' confidence as well, and even triggered them to not pay their mortgage on time. And this kind of the weak market has then reduced the funding crisis, the funding which is available for the developers again since early of the 2021. But I think even before the timing, the tightening credit condition was even a big problem for the developers, because since the August of 2020, the Chinese government introduced the three red line regulations for the property industry. By that time, more than 60% of developers has already hit at least one of the debt thresholds set by the government, and some of the famous or the largest developers has even breached all three the thresholds set by the government. Mm-hmm. So when the policy came into the effect since August 2020, the situation is getting worse and worse. Then this kind of the credit crunch has pushed many of the developers into a more stressed or more difficult situation, and with even some of them are defaulting. So that is why we can see that in the recent data just released by the National Bureau of Statistics of China a few days ago, that the overall investment in the property industry in the first 7 months of the 2023 has reduced about 8.5%. Mm-hmm. But I think when it comes to the slowdown of the economy, I think this property crisis is not the single reason for this slowdown in the Chinese economy. And also the decline in the consumption, which is actually happening within the domestic market, is also another big contributor, because we have seen that even during the 1 week Labor Day holiday in China, which was happening in the first week of the May in 2023, although the number of the tourists has increased a lot in China, but the consumption figure didn't see a very huge increase on a year-on-year basis. So I think together with this property crisis, this has become the two biggest contributor to the slowdown of the economy for the China case.
Thank you. Thanks, Sai Zi, Dr. Sai Zi, for shedding some light on that. Now, also, it's worth noting that China's government is unlikely to step in and provide massive support to property developers despite some structural changes occurring. Moving along from there, let's now look at why cracks are showing up in a pillar of China's debt market, Dr. Sai Zi, which is local government financing vehicles, or LGFVs, which account for about 9.3 trillion USD debt market, and the possibility of a credit crunch relating to that.
Yes, I think there are two entities which are usually supporting the property industry's development in China. One is the local government, as you mentioned. Another one is the bank. But for the bank, the good news is that the loans which has been made available by the bank to the developers or the buyers are still now a relatively small portion for the bank's total lending. And according to some of the publicly available data, we can see that the mortgage loans only comprise less than 20% of the bank's total lending by the end of the 2021. And also the property development only comprise only about 6% of the Chinese bank's total loan books. But I think the case which is not good for the local government, as you mentioned just now about the LGFBs, is because it's a totally different story. Because they're often heavily reliant on the land selling for some income, for the other investment, to generate the investment, and also for the other urbanization projects in the city. So I think this could be a further drag on the economic recovery for the local government as well, especially from the pandemic at a time.
Absolutely. And one final area, Dr. Sai Zi. So how could these multiple strains impact commodity prices, equity markets in APAC, and specifically Malaysia? What do you think can be done to perhaps help buffer against this in the coming months for the rest of Q3 and Q4 in 2023?
I think when it comes to about the spillover effect, it still somehow depends on how serious or how bad this property crisis could be in the next couple of the months. So I think on my personal views, I think in the next couple of months, in terms of the recovery of the property industry in China, an immediate V-shaped recovery might be not the case for China in the next couple of the months. But I think instead a L-shaped recovery might be the ending story, which means it will still recover at some time, but not so immediate in the next few months. So I think in terms of the impact on APAC, or let's narrow it down to Malaysia, as you mentioned just now, I think the biggest worry is about the sharp decline in the trade could throw the financial market into a tailspin. So which we already seen from some of data from Moody that this China's downturn or slowdown has already affected Malaysia's import-export in last couple of the months, and also has even also affected our export to Japan, Singapore, and other markets as well. So I think during this downturn period, our Malaysian manufacturers or the trade dealers could think about two things. Number one is how could you further improve the competitiveness of your products or services by increasing the technology added value or the component. And secondly is you have to work very hard to look for a more diversified export channels in the next couple of the months. Yes.
Thank you. Thanks very much, Dr. Sai Zi, for sharing those insights around China's economic slowdown and possible APAC impacts. We take a quick break now. Don't go anywhere. We'll be right back with Niaga Spotlight.